Okay, let's dive right into a little bit of market information. So today is Friday, April 3rd, and we're going to jump into Plymouth. So if you've watched any of the previous ones, I've done a couple towns. I think I did Marshfield, Situate, Hanover, if I can remember, and now we're going to look at Plymouth. And again, same viewpoint of what's going on, what's happened with prices, what might they do, and what are we seeing in the tea leaves from the standpoint of potential of real estate value growth, decline, whatever, right? Let's just look at the history because the history looks pretty similar to the other towns, right? Like I think there is always nuance town to town, but if you look at the grand scale of things, we have the run up of the 2000s, right? We have the peak for this cycle in '06. We have the decline from those years falling after, right? And you lost about $100,000 in value from the peak in '06 to 2012, right? We saw that same thing in all the other suburbs of Boston, right? Going down the South Shore. And then slow climb back out, right? You got your money back somewhere around 18. Again, that's pretty similar to before, and then it flattened out for a little bit, right? 18 into 19, you got your money back from '06 if you still owned from the standpoint of what your house is worth on paper, right? Now again, if you buy here and you needed to sell here, no fun. If you bought here and needed to sell here, not ideal because you missed this, but you're still good. It's 270 compared to this, right? So it's always relative. Real estate is always relative. Then climbing up, what we're seeing here is, you got the 2020 like oomph jump up right in value from, January of 2020. We were right back around here, right? Because we started, breaking even again in 18, 19, and then you got that jump up in 2020, and then that jump up through 2021. And it just keeps going. A little bit of flattening, that little hook in 2022 we saw in the other towns as well, and then up and up and up and up and up, right? So, we're well above the valley of the previous cycle. We're well above the peak of the previous cycle. And I think that's the most important thing to look at is for us to go from here in Plymouth to here would be bad. That would not, it wouldn't be, and in terms of like, how could you do that without there being something really bad in the economy happening? You'd have to build so many houses that the supply saturation so greatly outpaces the demand that the prices organically fall, right? Which isn't good either, if that makes sense. You don't want an overly saturated market because then that can put economic pressures on things that you don't even think are going to be economic pressures, right? If the builders are building houses with one thought of what the house is going to be, and they're just pacing out demand, but then things aren't selling and they need to take cuts and need to take losses, and then all of a sudden the tree it's just not good. You don't really want to ever go backwards, unfortunately, with the way that our system works for the value of the dollar and energies and all. You just don't. You don't want to ever go too far backwards, right? Like values were low in 2012 because of the negatives that happened here as they went down, right? This wasn't because the market was getting better for buyers, although it kind of was if you want to see it that way. But along this path down, it was a lot of bad things happening, right? It was a lot of people losing jobs, people losing lives, people losing houses, right? Not good stuff, divorces, like whatever ramification you could think about when the value of the dollar is going in either direction too far, right? Either the value of the dollar is eroding with inflation and prices going too fast, or the value of the dollar is becoming too powerful as prices go down too low, right? Like you don't want either direction side of the coin. So either way, we're seeing the same numbers there. Now, if we look at for sale inventory, it's pretty much again the same song and dance, right? We had a bunch of inventory in these years, going back to 2017, 18, 19, pretty much the same seasonal peaks that you see, right? You get into the dead of winter, inventory falls off as people buy houses, and as winter unfolds, you don't list as many houses, so you have that happening. And then as you go into spring, you get the peak of for sale inventory, and then summertime is when it really peaks, and then it starts falling off, and then up and down and up and down, right? That's the typical cycle in New England from that standpoint. Very, very similar. You might see some summertime dip, right? Because ideally you don't list your house 4th of July weekend, right? Like you just don't in New England if you don't need to. So usually the inventory is peaked because you have all of the houses that didn't sell in the spring market. You have all the houses that came on later in the spring market. And then you have all the buyers that kind of fell out of the market that, either got tired and stopped making offers or they already bought something. So you get a little bit of a bottleneck in the summertime of excess inventory compared to demand because of how fast and furious the spring market is, right? And then you just see the opposite in the wintertime, right? And then it usually balances out in the fall, and then the cycle repeats, right? So we're kind of seeing that same song and dance. And then COVID just perpetually took houses off the inventory market, right? All the way down until we had the low point, and then the low point 2022. Again, very similar to the other times, right? Very similar, decline in inventory going down. Again, same thing if we go to home value, that 2022 mark, right? It's going to be right in that hook. It's going to be right in that hook. 2022, right? And then you have, where was March 2022? And this is about where that hook happens, right? You have the buildup of the spring of 2022 in terms of values still going okay, but then that summertime hit, right? Of like, okay, what's happening with the market? What are rates going to do? Are they going to go up? Are they going to go down? Are they too high? And this is when rates were like in the fives and people were panicking about what rates were going to do. And now rates are in the sixes or sevens. So from that standpoint, go back to the for sale inventory. The low point, very similar to a lot of the other South Shore towns. And then a little bit of normalcy in terms of flow, right? Of like, okay, spring market into summer, right? Peak of total inventory available, into the winter time, it starts going down as you get into deep winter, back up into the spring, right? A little bit, not as perfect of, an up, down, up, down, up, down like previous month, which again, very common to see markets acting funky when the information is funky. People are thinking like, I don't know what a rate's going to do, who's getting elected next, what's going on. There's a lot of uncertainty whenever there's times of uncertainty, right? So you end up seeing odd statistics typical to the norm because of the variables in the market, right? So you're seeing a little funkiness there. But again, similar idea of we're starting to see inventory catch back up a little bit because the people that bought during these time frames, they're the ones that are quote unquote rate locked, right? Everyone that bought here refinanced here in 2020 and 2021. And then all the people that bought in 2020 and 2021, there's just a big number of people that have interest rates below 4%, right? That because of that, they're kind of handicapped to what's going to be a pain point to move, right? It's made the pain tolerance more tolerable, right? So like if you're in a 2-bedroom with 3 kids, a mom and a wife and a husband, right? And you're like, hey, the 3 kids are in 1 bedroom, we're in the other, but our interest rate's only 2.5%. And we could move, but do we want to? How painful really is it? Because the kids are fine. Like leave them alone in their 1 bedroom. Who cares, right? They're going to be fine. They don't really need their own bedrooms. There is probably a lot of people in that boat that it's going to take a higher pain tolerance for them to start entering the market. And we're just going to start seeing that organically happen more and more. And as we keep staying in this current cycle with interest rates, if interest rates stay range bound between 6 and 7 and maybe 5.5, right? If we don't have something that causes rates to take a momentous drop downwards, right? We're going to need a recession to have rates below 5%. It just is what it is. If rates stay above that 5.5% mark to 7 mark, somewhere range bound where we've been since, we've kind of gone to organic interest rates without any government intervention to stimulate the market, it's going to be a slow trudge to try to get inventory back to a normal level because you're going to need all the people that refied that bought during these years, refied here and bought during here. They're going to need the equity build long enough as they pay down their principal, along with their income rising, right? Ideally, to have that pain threshold be less tolerable to go, hey, it's not that big of a deal, we can move. And then also all the people that are buying in these windows can start laterally moving in these windows. And what I mean by that is if you bought in 2023 and your rate's 7%, and you're like, you know what? We don't really like our house that much anymore. We're already past the capital gains threshold. It's grown in value. So we bought a single family house in Plymouth in 2023, let's say, right? And it's grown in value still in 3 years. And we don't know capital gains on them. And if we move, the interest rate's relatively the same as was when we bought. So instead of like, let's just move. So you're going to see inventory unlock there as well. And then what I think that's really going to cause, just a human element, is going to cause the keeping up with the Joneses effect of as the lateral movers that have entered the market in 22 to now that have a relatively similar interest rate but have gained equity in the market because values have still appreciated in Massachusetts in most, suburbs, they're free to, Southwest Airlines, they're free to move about the country, right? So they're not sitting there like, oh no, we're rate locked. They might be running the numbers and go, we're at set, like I got clients moving now that are at seven something and looking at the rates and going, well, we're actually going to get a better rate, right? We gained equity. We're buying a relatively similar priced home, but we're just buying a different home that we like more, right? And we're actually going to be better off. You're going to see that cause the keeping up with the Joneses as people do that and have those fun stories with their friends and family of like, yeah, we bought the starter home and now we're moving. And then you got the other people that are in the interest rate from 2020 and they're like, we bought our starter home 10 years ago, but we don't want to move because the rate's too low. And our kids fight over one bedroom. And you're seeing your friends that are laterally moving that bought in the bad market of 2022 to now. That will cause some people to start whether it's right or wrong, it's going to cause some people to do the keeping up with the Joneses thing of like, maybe we should trade that rate in finally and just move, right? We can afford it. We can do it. We can shift some things around and maybe pay off some credit cards or pay the car off with some of our equity to change our holistic position of income and cash flow going out because we're going to take on a bigger mortgage payment. But if we don't have a car payment, we don't have a credit card payment, we don't have this, we have all this equity. Is the new rate that negatively consequential? I'm having way more of those conversations in the past 2 years than I did in 2022 and in 2023, right? 24 through 2026, starting to see more of those rate locked people shake into the market. And I think that's proof in the pudding in these numbers as we get close to the midpoint of what, inventory looked like prior to COVID, right? As we go down and the low point 2022 and start climbing back up to get inventory up there, right? And I think that shows also in the supply and demand of buyers coming back into the market as a lot of first-time home buyers in 2022 just said, I'm done. I'm not going to try because they tried during this market and they didn't get anything. And then rates went up and they just said, I'm leaving. I'm going to wait for rates to get better. Had a lot of those conversations in 2022, right? January, February, March, April 2022, a lot of first-time home buyers just said, I am taking a break. I tried to buy a house last year when rates were low and couldn't get anything. And now rates are high. I'm going to wait for the crash. I'm going to wait for rates to get lower. And then rates haven't gotten any lower and there hasn't been a crash. So they waited in 2022, didn't do anything, and inventory is slowly increasing, yes, but values are plateauing a little bit in some pockets, right? We're not up. We don't want to see this. This is too much. This is too steep. This is too steep. This is a little better. That's a little better. Too steep. We don't want that. You don't want $50,000 year-over-year increases in values, right? Too much. Too much, right? Too steep, little bit of an but different dynamics. There's no inventory. So although we're seeing prices flatten sometimes, but it's still growing, right? From that standpoint, it's a little steep, but the steepening is because as the supply and demand is shaking out, we're really not getting close to what we need for inventory. But also as the dynamics play out, we're getting more buyers coming back into the market that are saying, hey, I took a pause, but I shouldn't have. I wish I just bought in 2022. It's time now to have a couple of those conversations, right? You're seeing more sell-by clients come in because what really matters in the dynamics of home values is saturation levels, real estate velocity of how fast a house is coming on and going off the market. This is also called absorption rate. I like to call it real estate velocity because it's more about like how fast do houses come on and how fast do they come off, right? So that's really like what's the velocity of inventory coming on and how many buyers are available to then take that off the market. And that's also why it's called absorption because they're absorbing them back off the market, right? So that is playing in as we're seeing inventory go up, you should think if inventory goes up, shouldn't values be going down? Kind of, but it really depends on how much bottleneck of demand there is, right? And the longer we stay in this cycle of interest rates being quote unquote higher than the last cycle, right? Because the last cycle was from here, let's call it, when was the bad part of '07? September, right? And then eventually they started quantifying easing and lowering interest rates, and rates were low from like here to here, right? Rates were really low. Rates were inorganically low relative to what rates are as an investment vehicle for a rate of return on the marketplace. So the value of loans as a marketplace, which we're capitalists. So everything's got a market value. So the market value of money from the standpoint of I give you money and you give me money back, right? As a loan was inorganically low because the government was stimulating our economy to pull us out of the market corrections of '08 based on what was happening then with, all the foreclosures and the bad loans and all that fun stuff, right? So we said as a country, hey, we got to rebuild, we got to get our economy back humming. Let's make money free so that money can flow around the country as much as possible so that we're stimulating job growth. It was really low inflation because this was so bad. This is a bad economic cycle that even with all the stimulation of the economy, there wasn't any real applied inflation, right? Like the cost of things during this cycle here wasn't like dramatically increasing like what we saw in 2020 through 2022, right? So the government inorganically brought rates down. So if you're my age, 36, 37 actually just turned, this is your whole adult life. So you're thinking if you're in your mid 30s, late 20s, early 40s, majority of your adult life is inorganically low interest rates, right? Whereas the history of interest rates shows us that whenever the government doesn't get involved in some way or another, or there's no catastrophe to, change the underwriting of the value of the dollar and the value of loans and on the marketplace, interest rates have a hard time being below 6, right? So the longer we stay in quote unquote a non-stimulus market, that the Fed and the government isn't trying to incentivize growth in the marketplace because they're fearful of inflation, because they don't want to grow they don't want to grow the economy too fast, 2020 and 2021, to cause inflation, right? So they're trying to restrict it from that standpoint. If we stay in that cycle, we'll eventually start to see these numbers continue to hopefully over time go up and up. Because then again, you're getting keeping up with Jones's effect of the people that have the low rates. Maybe they pay their houses off and like, hey, it's time to finally move. We can buy the next house cash. That'll start happening too. But all these people that have the low rate, but you know what? We're not going to move. Let's pay it off, pay it off. Now we have all the capital. Let's move then. You'll get those people entering the market. You'll start getting people that are just aging out of inventory and hitting the market. You'll get people that have bought during this cycle, re-entering the market, new inventory coming in. Eventually, it will start to ideally balance out outside of any variable. And you're just starting to see that here. Again, if you draw a straight line from here to here, right, the peaks and valleys, the valley is lower here than it is here, right? Peaks and valleys, if you draw a straight line here to here, here's the peak of inventory available, same idea, right? We're probably going to keep going in that trajectory, bearing that the cycle continues playing out the way the cycle is, not taking into account future variables, right? I think that's too hard to try to handicap. So that is a deep dive into Plymouth from the standpoint of what it's done over the past few years. Let's see. Okay, so now I want to chat about what's going on with interest rates, what I think might will happen. I did my prediction at the beginning of the year, and unfortunately, my prediction is playing out to a degree or another, where I did a little bit of a heat map prediction and said, I think most likely if everything stayed the way it was, we probably would have saw rates between 5.75 to 6.25 would be the most likely outcome. A potential for rates to be slightly lower than that, but you know, also a decent potential of them being higher with an easier chance of them being higher. The easier chance of them being higher is just playing out right now. There is a lot of conflicting information that's going to make it really hard for the mortgage rate market, the bond market that causes mortgage rates for it to be stable, right? The bond market, the stock market, just expect both of those markets over the next 3 months to be very unstable, right? Whether that's rates going dramatically lower, rates going dramatically higher, right? Stocks going dramatically lower, stocks going dramatically higher. And I think that just plays out based on the fact that we're in the middle of a war, right? So we're in the middle of a war, and also the data points are not reliable anymore, right? So a lot of the data points, like today was a jobs report, and it showed a massive increase in jobs, but then there was a revision for a massive loss in jobs recently. And then if you really peel into the numbers, it doesn't look like it's real on the surface. And we're kind of seeing that play out a lot in the fact that the Fed and all of these things are so forward, and everyone's like the amount of people I have conversations with that are just what I would call normal citizens. If you're not a realtor, lender, an attorney, if you're not involved in real estate, then you're a normal citizen, right? That makes sense. And I mean that in a good way. Like it's the same idea of like, it's just a different world if you're involved in the marketplace. So for normal citizens, prior to COVID, I never talked with people about what the Fed was doing, right? The Fed was this thing that just existed in the back room, and we knew about it, know it's important, right? They dictating our money system to a degree or another. We know it's important, but most people weren't as aware of the Fed prior to COVID. I think COVID, everyone being home, everyone having social media, and all of these talking heads in the government just being forefront with us, and then bringing the Fed forefront. And now they're like, I know who the chair is, and Chair Powell's saying this and that, and what are the rates going to do? And what the normal person now is more, I don't want to say in tune with that. They're more aware of what the Fed is doing and that the Fed impacts interest rates. Also, rates are double than what they were during that period of time. So it made it easy to go, oh no, what is happening? Why are rates going from 3% to 6 to 6.5 to 7? What's this Fed thing? What are rates going to do? Because of the hyperbolic change, it just made it easy for Fed to be kind of brought to this new level of media concentration from um, people that normally wouldn't pay attention to that stuff, right? Even when I first got into lending, I knew what the Fed was. I wasn't paying attention to it. I was just trying to understand lending, right? Clients weren't really paying attention to it. And even when I was talking to colleagues, like, yeah, it's all important stuff, but it was mostly just like, hey, you can't control rates. Rates are going to do what they're going to do. Let's just help clients make good decisions, right? Which is still the fundamental truth, but there's a new undercurrent of now having the knowledge of how much this impacts our economy and how much clients are now aware of the pieces of the puzzle that impact our economy, and they're being looked at a lot different, right? We're looking at year-over-year statistics that don't make sense when we drill back on a month to month. So like the year-over-year statistics, like they're doing these massive revisions to say like, hey, we created all these jobs. And then a year goes by and they're like, actually, when we look back in time, we didn't create all these jobs, right? This is what inflation's doing. Actually, when we look back, we revise it and this category of inflation's off or this. It brings me to the point that the data is not as good as it should be, or maybe could be, for how important it causes markets to fluctuate in a knee-jerk reaction now because everyone's getting information so fast, right? That's going to be the tug of war. The news breaks, the market shifts, but then they digest the information, the market shifts again. right? It is that quick, that instant, where the moment there's news about the Bureau of Labor Statistics jobs report, the market shifts based on the headlines, and then the market digests the actual information, and the market shifts again, right? It never really moved that fast before, right? I was at a ski resort and I was overhearing people on the gondola this winter, or maybe it was last winter. They were chatting about the jobs numbers. They weren't, and I asked them, I was like, what do you guys do? They were like something in finance, something in tech. They weren't even in finance. And they're talking about the jobs numbers. Maybe it's just because I'm older. That's what all people talk about. We have AM radio on and just chatting about politics and jobs reports and inflation and taxes are too much money. Maybe it's just typical old guy stuff. And either way, they were even saying these numbers look ridiculous. There's no way this is actually really happening. It doesn't feel like that boots on the ground. And when you really dive into some of these categories or buckets of these big data points that we look at and actually ask what's creating these numbers, a lot of them are surveys. Like the one of the surveys for the shelter inflation, which is I think the owner equivalent rent, is a survey. It's just asking people if you were to rent your house out, what would you rent it out for? That actual rent that's happening, does that really matter? Is that a real number, right? Like the unemployment rate for the Bureau of Labor Statistics, a lot of it's a survey. They just back out some numbers. It's not really like, hey, let's all put you in line and tell you who's working, who's not. I haven't been surveyed in one of those surveys once. Is that a real number? Is that really the unemployment number? Right? Like that. And it's not to say, hey, we're trying to get these numbers. 100 years ago, that's all the only way you could get data. Just go around. Hey, do you work? No, I'm not working. Okay, great. Tally, not working. Hey, do you work? Yeah, I'm working. Okay, great. Working, right? Like that. This is the only way we got information. There wasn't an easy way to do it. I don't even think there's an easy way to do it now. But the information is so in everyone's face now, and we now know the cause and effect that it does to the market. And the market is moving at such a faster pace. I was talking to a colleague the other day who's been in lending for a while, and she was chatting about how, back in the day, the big thing that loan officers would do is all the loan officers would drive around on Fridays and just drop off rate sheets at real estate offices, right? So then the realtors were ready to go with the weekend information of like, what are rates this week? Rates moved once a week. So all the data points, like there was still data happening. There was still a bond market. There was still all of these things in flux and dynamic and economic numbers happening, but rates moved once a week. You changed the number once a week. Rates can move now multiple times a day. The mortgage market is changing at a faster pace day to day than it ever has before. And I think you could almost ad lib the mortgage industry for any other industry. We're so fast paced now with just news. Everything's like, get it now, get it over with, right? It almost can be exhausting. So I'm a big proponent of like, take a step back. What can you do to flatten that if this is going to be the new market, right? If rates are going to be in this perpetual tug of war of is the data good? Is it bad? What's going to happen in the future? I think that's going to be the case. I think rates are just going to be in this perpetual tug of war. What's going to happen? And what I think is going to unfold over the next few months is going to be very highly dependent on how quickly this conflict ends and how it ends, right? If this conflict ends quickly and ends in a position where there's peace and there's, potential economic prosperity for the country of Iran, and we can all look at it and go, okay, it's over. It wasn't great. I don't think anyone's a big fan of the fact that it's happening right now in any category of anything, right? Even if you're for the war, I don't think you're a big fan that it's happening. And if you're against the war, you're definitely not a big fan that it's happening. I don't think anyone's a fan of wars happening, but I think we're all fans of when they end. Now, I think it depends on how it ends and when it ends, because that's going to completely change how the data matters in what unfolds over the next few weeks, right? We're getting inflation next week. Um, if the war is in a bad position and we have bad inflation, it's going to be really bad for interest rates. If the war is in a good position and oil's starting to come down because maybe some stuff happens this weekend that starts us in that direction, or next week, inflation won't be as consequential because maybe the market thinks inflate. It's all going to depend on the data, and it's happening now. Like we're gone from the, rates changing on, only once a week and update your rate sheet once a week and see what's happening and let markets digest information longer. Markets are changing on the news headline, on the narrative of the news headline, and then on the actual deep dive of the information creating the news headline, right? So as stuff breaks, you almost get like tranches of change based on one actual change. Whereas before, the market had time to digest, like, okay, let's digest the jobs report for a little while before we start moving in certain directions, right? Now, what does that mean for you as a realtor, as a consumer? How should you handle that now? I think you should almost not pay attention to it. I think the best thing you could do is unfollow the TikTok finance guy that's not your financial advisor. If you have a finance guy on TikTok, if I'm your finance guy and you're taking everything I say and it's like, and I'm not your financial advisor and I'm not your mortgage lender and I'm not having a conversation with you about your actual finances and what you're making for a decision, take my information as information, but mostly ignore it unless you call me and we have a conversation about what you have going on, right? So like unfollow all of the people that are giving you financial advice that aren't actually giving you financial advice for your life. They're telling you what the market's going to do, what's going to happen, what choices you should make, where should you put your money, you should do this, you should do that, don't buy real estate, 20% down, 10% down, get an arm, get a fix. If that's not actually your financial advisor, and if it's not actually your mortgage loan officer, none of it matters. Completely ignore all of it. All of it is completely useless because you need to filter that information through your own nuanced perspective against what you're trying to achieve in life relative to your current financial position and where you're trying to move to. That's the only time that information is important, is when you're actually discussing that. If you're just putting someone on TikTok and they're like, real estate's going to crash, and you're like, yeah, I'm not going to buy real estate. It's going to crash. TikTok guy said so. Where is it crashing? What's crashing? What's going to cause it? Just ignore, right? Rates are going to do this. Yeah, rates are going to do that. I'm guessing when I say I think rates are going to do something, right? I'm looking at it in cause and effect, chicken and egg. I think if this happens, rates are going to do this as a cause and effect thing. I have no idea when or if things are going to happen. I'm making complete guesses by looking at the tea leaves. But if you actually talk to me about making a choice for your house, my suggestion to clients is always, let's try to lock in your rate based on what you're comfortable with. Maybe it's paying points, maybe it's not, maybe it's getting credit. How are we structuring your scenario for your life relative to what's happening in the market, right? We don't really want to gamble with, well, what might rates do and how should we play it? We should be trying to remove that gamble from the position, right? So that's what you should be doing as a realtor, as a client, is how can you remove the gamble? Can you cap your interest rate for 90 days? We have that available. Can you lock your interest rate in during your pre-approval? Other lenders have that available as well. Can you make it so that the fact that the market is moving so fast around you, how do you get it to slow down? You get it to slow down by using those types of tools in the market, talking to the lender and saying, okay, how can I set myself up for buying a house in the next 90 days, knowing that over the next 90 days, we might see the level of market fluctuation and change that 10 years ago took 12 months to happen, right? So now that market volatility and change is occurring in a way tighter window, and they can just add to an already stressful event of trying to sell a house, buy your next house, or buy your first house, and you're like, oh no, rates are going from 7 to 6 to 6 to 7 to 6.5 to 5.5 to 8. And that was in the past 30 days. Literally in the past 30 days from the end of February, rates were in the high fives. And now we flirted with the low sevens, high sixes, right? With no discount points, right? From that standpoint, like it's 30 days. And who knows what the next 30 days looks like. We might go right back to 60%. So in a 60-day window, rates could have gone all the way from 6 to 7 back to 6. That's not a long period of time for that much fluctuation, right? Prior to COVID, that could take a whole year to happen. The rates went slowly up, slowly down. Maybe a few knee-jerk jumps every once in a while, but not like this, right? So that's my best advice. How do you take that knowing that this is just kind of the current market and flatten it? Lock a rate in during pre-approval, cap your rate during pre-approval, get underwritten during pre-approval, run numbers based on worst case scenarios where rates might go during pre-approval, pad as many of the sharp edges as you possibly can, because what that's going to do for you and your clients is if you're a realtor or a client, it's going to allow you to make confident decisions based on the parameters you've already created within your nuanced situation, right? Like if you run the numbers, you go, okay, I know my interest rate's capped at 6.99 for the next 90 days. So now it doesn't matter what rates do, right? If rates go higher, lower, great. You can take advantage of lower rates, so on and so forth. But now I'm protected for the next 90 days, right? Or if you don't do something like that, you look at it and go, well, if rates right now are 6.5, what if rates are 7.5? Can I still buy a house? Have that hard conversation, right? Even if you don't like the numbers and you're like, well, I can still buy a house. There's still something in my budget there. It works. If you don't have the conversation, it just means you're less prepared for if that happens. And if that happens and you're less prepared, you might then make an emotional decision. And you might do what those clients did in 2022, at the beginning of the podcast, and said, hey, rates are higher. I'm out of here. And even though I'm running the numbers with them saying, hey, you still qualify. Nah, I'm gonna wait for them to be better, right? Maybe shame on me for not saying to them as rates were going up or when rates were better. And I think a lot of us did this, right? I didn't see rates going that high that fast, right? So I didn't have those conversations with those clients ahead of time going, hey, I know we're at 3 now, but would you still buy at 5? Would you still buy at 6? Right? Like I don't think anyone saw it going that fast, that high, that quickly, right? So now knowing what we know and how rates are moving, I think it's worthy to run them if you're not getting a cap, if you're not locking a rate in during pre-approval, and you're in that position of discovery of figuring out, can I sell my house? Can we move? Can we buy our first house? Figuring that all out. During that period, pad as many edges as you possibly can, right? Nerf the room. Get rid of all the sharp points that might hurt you, because then you can go to the market with the goal in mind of I'm moving, I'm buying a new house. These things aren't relative to the externals, right? I was talking with the client, agent about this the other day, and we were kind of joking about this of like how much markets move based on the external information, which it just is what it is. Humans make decisions this way. I'm not going to change everyone's mind here with this video, but I think it's relevant to talk about it. During election years, leading into the election, real estate volume goes down. After the election, real estate volume comes back. A lot of that is people going, well, let me see what happens if my guy or gal gets elected or not elected. And then it happens, and they go, oh, okay, the world's still here, let's still move, right? The weird part for me about all of that is, are you moving because of who's president? Were you moving if ABC is happening that you don't have any control over? Or are you moving because you don't want to live in your house anymore? Are you moving because you're trying to get to a different school district? Are you moving because you're trying to get closer to grandma? What's the reason you're moving? Is it just easy to say, oh, ABC is happening. I don't want to actually find out if I want to move. I'm going to try to nail it perfectly. right? Like if this person gets elected, I think values are going to skyrocket, so I'll wait. If this person gets elected, I think values are going to plummet, so I'll wait. I know people are making those choices, and I know people are stopping real estate right now because of what's happening with the conflict. I know it's happening. I had someone tell me it the other day, right? Rates are high because of the conflict, and I'm nervous about what values are going to do. Valid viewpoint, completely valid viewpoint. I like to offer the contrary thought because my contrary thought was, well, were you only buying because there was no conflict? Is that why you entered the conversation of buying real estate? Call your realtor and say, hey, we're not in the middle of a war right now. I want to buy a house. Oh, crap, we're in the middle of a war. Never mind. Right? No, no one is ever going to the market, particularly for a house that you're going to live in, saying it's the right time because of all of these external dynamics. Right. It's the right time because of what the Fed's doing with rates. It's the right time because of what interest rates are. It's now I know fundamentally that's what causes a lot of people to move, right? Or start the conversation. I'm trying to offer a different viewpoint of opinion that you should be looking at it as more first principles than externals. The first principles are, do you want to be a renter? Do you want to be an owner? It's the first question to ask. The home you want to live in, do you want to rent it or do you want to own it? That's step one. Step two is then the deep dive of the financials. How much is rent in my market? How much is owning in my market? What does it cost me? What's the liability? Start having those conversations. Figure out your budget. Then you start having conversations with lenders about what am I capable of doing? What do I qualify for? And you go down the road of what am I willing to do? What am I willing to pay for rent? What am I willing to pay for a mortgage? What am I willing to pay for a house? Right? You start with all of that. None of those questions and answers have anything to do with what is happening externally. The numbers do, home values, interest rates, like the numbers that make up those categories as you're discovering what's available to you and what you're capable of doing right now in today's market. Yeah, they fluctuate based on the externals. But your life shouldn't fluctuate based on the externals. Your life goals are your life goals. If you're sitting there and you're like, I don't want to be a renter, I want to be an owner, and you try to time the market around all of the externals, you will perpetually be stuck in that because there'll just be a new external. There'll just be a new thing, right? There's always going to be a new thing on the news. There's always going to be a new reason why rates are higher, lower, sideways, left, right, up, down. There's always going to be something new, right? Which is why you stay with the principles of what you're trying to accomplish. And if you're getting advice from someone who you don't share your income information with, financial advisor, an attorney, a confidant in your family, if it's someone that you're not having a one-on-one conversation and saying, hey, I make this amount, I have this amount in the bank, I'm currently renting, I want to buy, I want to live here, the information you're getting from them is just information, it's not advice. And that removes all of the media, all of the news, and it removes all of social media, unless you're following your financial advisor on social media and watching his or her videos, right? You're following your attorney, you're following your lender and watching his or her videos. If they're not that person for you, the information is good to have. Don't completely ignore it, right? Because you still got to make life choices based on like where you want to live based on external information, right? Like, well, I don't want to live there because the crime rate's high, right? Like, okay, the externals matter a little bit, but you should be starting with your principal reasons as to why you're ever even thinking of buying and or moving anyway, right? And if you can look at it and go, well, was I only buying because this thing wasn't happening, right? Or was I moving because of a different reason? And now there's an external element that's changing the dynamic, and maybe I should change my underwriting of the dynamic. But I think at that point, it just starts throwing you down a rabbit hole of asking the right questions, right? Of like, why would I be nervous because of this event that's occurring that I have no control over, right? And if it goes bad, if it goes good, I still have no control over it, right? And we should be moving in the arena of like, let's hope it goes good. You should be betting on your life that things are going to go good because that is the arena that hope lives, right? And that's where you can eviscerate fear because that is in between the ear thing. That makes sense, right? And I'm going down a deep rabbit hole here, but I think from the standpoint of what rates are going to do, where they're going to go, going back to my original prediction, if I had to handicap that now, I think we're still in the same spot we were with my original prediction. It's, you know, all things being aside, if we're just looking at the fundamentals of the economy, rates are probably somewhere in the low sixes, high fives, mid sixes. The conflict is a giant rock that changes that dynamic and makes all of the other data points not as important. But it's the same thing. It's just going to be volatile. That it's going to be a lot easier for rates to be higher in this current market dynamic than it is for them to be substantially lower. So the moment you're just okay with that, that it's easier for rates to be higher than it is for them to be below six, right? And you plan for that and you have a good plan of attack to the market, you can lessen the feeling that there's this rock and hard place of rates going back and forth, right? So I think that's my best advice as the podcast for this week. Reach out to me if you need me.